welcome to Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. Mutual funds are an integral part of a personal finance plan, and there are funds for all our needs, from tax saving to retirement planning to even saving for that holiday. Now, this week on the show, we profiled some of the biggest funds of India by size. We break them down in terms of performance. We tell you about the men who manage these funds and, of course, get you analysis on whether these funds should really be part of your portfolio if they're not already there. Helping me do this mammoth task this week is Feroze Azeez of Anand Private Wealth. Feroze, thanks for joining us. Welcome to the show as always. So it's an interesting idea because even when I was thinking, okay, at the top of my head, if I have to name the biggest 5 funds, it wasn't that clear. So we thought it's a good idea to do some homework and do this exercise. So, what has your initial analysis thrown up in terms of some of the biggest funds that are out there?
Yeah, I think it's a very good idea, Surabhi, to take up this topic for this segment or the section. Why is it important is there are about 500, 600 odd equity schemes. Now, not all of them will have a clear distribution of assets. There will be some schemes which will have so much more than the rest of them. So we have to give emphasis to where people's money is invested.
Absolutely.
So point one is that the large schemes seem to have, over the last few years, underperformed. So is there something for us to read and then take our strategy according to that conclusion, which you can derive out of inferring from the data which is thrown up? So point one is, which throws up, is the top 3 schemes of this country belong to one asset management company, right, which is HDFC. Then you have Aditya Birla's one scheme, and then you have KOTAK, which has another scheme, and then SBI. So the point one which I'm making is it's important to analyze as per the assets, because the viewers would own them and we need to analyze them, being duty bound to do so. Second is that there's a large skew of these large funds across one AMC.
Oh, absolutely. So, well, that's the slight tweak we've done. We thought we'll give you the top 5 biggest funds of the country. However, since we realized that the top 3 of them come in from the same asset management company, that's HDFC Mutual Fund, we decided to throw in a 6th fund. So, in effect, we're looking at 6 funds today as we get started. The biggest one of them all, the biggest fund, mutual fund, equity mutual fund of India, happens to be HDFC Prudence. We are talking about an AUM, assets under management, of a whopping almost 38,000 crore rupees. That's a lot of money for Mr. Prashant Jain and his team to manage, Feroze.
Correct. That's the largest scheme. One scheme holding 38,000 crores, which is the latest data as per April, is a lot of money. So point one is that it has large assets, and it's the largest one. Point two, Prashant Jain, who's the CIO himself, manages this from 2003, June. So that's a long period, almost about 15 odd years of managing one scheme. Then if you go on to dwell deep into it, its mutual fund is a wrapper. It's a name given to a set of stocks. So it's very important for a person to own it and also look what is there inside it. So there are several things which one should look at, but you rightly highlighted that CIO manages it himself for the last 15 big years.
Okay, so let's get started with the Prudence Fund. If you could just run us through some of the details, like, its track record and typically the nature of this fund as well.
Correct. So first comes the strategy. First, now we have spoken about who manages it. So the good part is the CIO manages it himself. The second part is the strategy. What is the strategy? We need to spend a minute on that. One is it invests about 75%, 65 to 75% in equity, 20 to 30% in debt instruments. So that's why it's called a balanced category, but it is equity in nature because its skew is there. And its strategy is to buy businesses in the equity side, which are strong businesses, bottom-up picking. Bottom-up, by which I mean the company, if its company is good, then you're not too worried about which sector it belongs to. That's what is called bottom-up strategy. So it follows a bottom-up strategy. It has 80 stocks in it. 80 stocks is a lot of stocks, right? Then the top 10 stocks actually own about 43%. The 10 stocks hold 43% and 25 stocks hold 60% of the money. What are those stocks is also good, interesting stuff to analyze.
Absolutely.
Infosys is the largest holding with 7.3% in Infosys. Then you have L&T, then you have SBI and ICICI. These are the top 4 holdings of this fund. So a large portion of this 37,000 crores, upwards of 10,000 crores, is held in these 4 stocks. So why is it important to know? So that you can see whether it it gels with the thought process of your advisor.
Exactly.
So in certain cases, you might not be in love with financial services, but if the fund holds 20%, 30% of its money in financial services, it's always wise to look deep in and see if there are some contradictions between what you think, your advisor thinks, and the fund manager thinks.
Okay. Now, having said that, return analysis, and what would your advice be on HDFC Prudence?
So, return analysis and risk analysis are the two other sides of the same coin, which is investments. Return has been very poor. So it has underperformed Nifty by about 6-7%. If it underperformed by 1-2%, I would be okay because it has debt in its portfolio, point one. Return has been not so good. Anand Rathi uses a different method of ranking it. So in that ranking, it comes in the not in the top 25% of the schemes, in the second quartile.
Okay.
So I would strongly recommend against the scheme.
Okay.
I know it's the largest scheme, but it will not create as much value as you would want to. Maybe if you want to switch from HDFC Prudence to the HDFC basket itself, then you can go into an HDFC balanced fund, which is relatively smaller in size, but has the agility and the vigilance being taken care of in that scheme. So one last point from a risk perspective, every fund has the attribute of capturing more upsides and less downsides, but this scheme, on the contrary, captures lesser of the upside and more of the downside. That's why the performance is bad.
So there you go. Size cannot be everything on its own. There are other parameters that you have to keep in mind, and Feroze has outlined some of them. Let's move to the next, second biggest fund of India, and this again is from the HDFC universe. We are talking about the HDFC Equity Fund, again managed by Prashant Jain, right? This one?
Yeah, this again managed by Prashant Jain. These are both very, very old schemes, and that's evident in the number of the assets they manage. Point one, the fund manager is Prashant Jain. This is the largest large cap scheme, so to say, in the category. It has about 21,000 crores as of April, and has a skew of close to about 52 stocks in the portfolio, which is relatively lesser than Prudence, which we just saw. 80 was too many, 50-52 is reasonable, and all of them in the large cap category. It has 4 sectors again, which are the larger holdings, which is one is industrials, financial services, utility, and technology. These are the sectors it owns. Anytime, why is it important to see when the fund manager is already looking at it? Is because if there's a dichotomy between your strong opinion or your advisor's strong opinion and the fund managers, if there's a staring contradiction, then you need to act. That's why I'm mentioning what sectors hold, right?
You know, when I look at the stocks, for this fund, again, it has the same names, Infosys, State Bank of India, ICICI Bank. So could that be a bit of a problem here, as in Prudence's case?
Yes, it would be. See, what happens is, if you are in one fund house, so what is the conclusion one could derive is, firstly, being in such a large scheme is not a good idea, in my opinion.
Okay, why is that? Why do you say that?
Why? Because there is a strong correlation between underperformance and the size, which statistically is thrown up out of the top 10 schemes we have analyzed for different years, and saw that size is becoming a deterrent. And we did a survey amongst fund managers as well, and they very subtly we did this survey because you would want to get the information heartfelt, and then most of them said a larger size becomes very difficult to manage and generate value. So in my opinion, large scheme is a bad idea, very large scheme. Second, large scheme, 2 large schemes of the same fund house is catastrophic, in my opinion. I'm using stronger words so that there can be action to the viewers. Why? Because there is going to be a large intersection, because the person is same. You can't have very
thought process is the same, and chances are his stock selection might be the same.
Correct. And you would see intersection of like HDFC Prudence and equity. I would be surprised if you looked at the intersection analysis, if the intersection is not more than 50-60% of the AUM. So you have different names, but the same underlying.
So that's the extent of overlap in terms of the stocks that these two funds are owning. Even if they're different funds, you're not getting the benefit of diversification if you're holding both of these in your portfolio.
Correct. And if in a year where financial services have taken a beating, at least as we stand today, then you would be hit on both the sides. So investment diversification is all about complementary products which do well in different points in time, so that your risk comes down. Otherwise, the risk actually compounds instead of deteriorating.
So I already have a sense of what you might say about this fund in terms of risk reward. Should one invest? Should one not invest? But just run us through the view and, of course, the performance analysis as well.
Like you preempted, I would definitely give an exit to HDFC equity. Of course, I've been giving an exit to this fund for the last 4 years. May 14 is when that was, of course, a tough call to take. But I think continue to give an exit call on the HDFC equity. Of course, it has a large pedigree and a very, very good fund manager managing it. But I would choose another fund managed by Prashant Jain, but not of this nature. And if the capability of the fund manager is stupendous, giving him mandates of managing large cap schemes is like tying his hands down. So to summarize, an exit to an HDFC equity as well, unfortunately.
Okay, so from Feroze's side, it's a no to the HDFC Prudence, it's a no to HDFC equity. You said you would opt for another scheme from the same universe. Which one would that be?
That would be the third largest scheme.
Okay.
Okay, which has been managed in a different fashion. So that's HDFC MIDCAP Opportunities, managed by Chirag Setalvad. Okay. Incidentally, that's the third largest scheme, and HDFC holds 3 big schemes.
So on that note, I'm going to take a break because we've hit our break timing. That's an interesting note to take a break on. If you want to know which is the third biggest mutual fund equity scheme in this country and the one that also has Feroze's approval, stay tuned because we're going to be coming back and analyzing this HDFC MIDCAP fund on the other side. Welcome back. You're watching Money, 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 and this week we are profiling the biggest mutual fund schemes of this country. 2 of them happen to be the top 2, that is, from the HDFC universe, and so does the third. That brings us down. I'll actually quickly do a recap if you're joining us now. The biggest mutual fund scheme of the country, HDFC Prudence, has assets under management of almost 38,000 crore rupees. After that, we discussed the HDFC Equity Fund, and now we are down to the HDFC MIDCAP Opportunities Fund. Feroze, more about the scheme.
HDFC MIDCAP Opportunity amazes me the way it has been managed. Chirag Setalvad is the fund manager. Of course, is part of the team of Prashant Jain's team. So I think the way he has managed a MIDCAP scheme at 21,000 crores almost is stupendous. And what happens is, unlike the other 2 schemes, these schemes have hardly any intersection, largely because the categorization is different, that is large cap and balanced. This one is mid cap. You have Cholamandalam, you have Sundaram, you have different kinds of stocks which have 0 intersection. So this is a super scheme in my opinion, and so far it has not shown any disadvantage of size, and I hope that it will continue for the next 1, 2, 3 years in the same fashion. In my opinion, again, they have a bottom-up stock picking strategy. Bottom-up stock picking is very critical in a mid-cap fund. In a large-cap fund, in my opinion, the strategy should be top-down, choosing the sector first and then the stock.
Sure.
But that's what is meant by top-down. Bottom-up means choosing the stock first and being agnostic to sector. So it has a very, very good bottom-up stock picking. Third point which I want to make is the decisions which Chirag Setalvad has taken in this fund, the past 100 decisions if you analyzed, because he's managing this from 2007. Right. So he would have taken several investment and disinvestment decisions. The number of right decisions to the wrong decisions taken is amazing. Okay. Right? That's the one thing which should be measured. But for a benefit of the viewers, I'm just saying the synopsis and lack of time, that the right decisions are significantly more than the wrong decisions which are.
So basically Chirag gets it right far more than he gets it wrong, and that's a great thing to, of course, have as a fund manager. Some of the top holdings, I'm just looking at what this fund owns: Cholamandalam Investments, Sundaram Fasteners, Balkrishna Industries, Voltas, Hexaware, RBL Bank. It's a varied mix of stocks that is part of this fund. Return analysis as well. I mean, 5 years, we're talking what, 27, 28%. That's far better than the underlying index, the mid-cap index, right?
Correct. So HDFC's fund management capability, if given wings and a larger canvas, has always proved better. In mid-cap space, you have a larger canvas. In large-cap space, you have to mirror the index. So it's not Prashant Jain's capability used there. Because Prashant Jain's capability is right up there. You have to give it a mandate which is flexible enough. And that's what this fund does. And so return, they've beaten the benchmark by 4%, last 1 year as well, which shows up. So my recommendation, HDFC mid-cap opportunities and HDFC small cap fund in the HDFC category could be a good replacement to the large cap and the balance fund in their same basket.
All right, so we have done the top 3, and all these top 3 funds happen to be from HDFC Asset Management Company. Let's come to the 4th biggest fund of India, and this one is the Aditya Birla Sun Life Frontline Equity. Huge numbers here as well. We're talking assets under management in excess of 20,000 crore rupees. So this one, I'm guessing, managed by Mahesh Patil.
Mahesh Patil manages it since 2005 November, and you can very clearly see wherever the fund manager has stuck on for more than a decade, those end up becoming large schemes. So there's something to infer from here. So Mahesh Patil has managed this for 13 years, and he's of course done a great job. Because of the size, it is again not in my recommendation list. It has fallen prey to this large fund size. So in the Birla category, I would want to be quick and inform the viewers that Birla Equity Fund is a good replacement to Birla Frontline, because the fund management team and the capability because the CEO of this has always been a fund manager. Bala has been a fund manager. So it's a technical guy running the company, and I think they've done very, very good justice. So then looking at the funds and sector, of course, you can look at sectors which are financial services, the usual suspect, large cap schemes, consumer cyclicals, and the third one is technology, of course, and consumer defensives are these four top sectors of this fund.
Let's now move down to the next one, which is the KOTAK Select Focus, also a very, very popular fund. We get lots of queries on this. Again, a very big fund as well. We're talking 19,000 crores here. One of the marquee funds from the KOTAK universe. Your opinion and analysis of this?
KOTAK is managed by Harsh Upadhyay, a very good fund manager. And again, when you look at his right to wrong ratio, which tells the credibility of the fund manager, is very, very good. And since it is a large cap scheme and 19,000 crores, and how they have countered their problem of being so large has been commendable again. So it's a recommended scheme, and you can still continue to hold the scheme for the next couple of years because it's a flagship scheme of KOTAK. Unlike in the HDFC basket, you have three schemes which are large. Here KOTAK has one large scheme, and the second large scheme might be right down there. Not that there is so much attention needed in three different schemes. So KOTAK Select Focus continues to be my recommendation. And Anand Rathi's ranking gives it the top quartile, not on the basis of past performance, but future indicators. So statistically, you can analyze the future from the past data. That's called regression analysis. That also throws up a good output to it. So recommended scheme, Harsh Upadhyay is a fund manager in the large cap space, 19,000 crores. And over the last couple of years, it has done justice, and it has outperformed the Nifty reasonably well. And the risk ratios are lower than the Nifty in certain cases. So that's a good risk return reward.
So what is it that Harsha and his team are doing differently? Because this is also a very big large size fund, but despite that, you're willing to overlook your, don't go in for a very big fund rule to go in for the select focus. So what do you think is happening differently here, which makes this fund stand out?
They are top down. They're not bottom up. Large cap schemes should be top down in strategy. They've got their sector allocation right, and the stock selection, they've been unconventional, and they have moved away from the benchmark indices. Like Nifty and Sensex are good benchmarks for large cap funds. They've moved from their benchmark. They have shown courage to be away from the benchmark and still beat it. And I think that's where the fund manager's fee becomes justifiable. If I have to replicate the benchmark, I actually don't need to pay 2.5–3%. So moving away from the benchmark, having a top down, these are two core reasons why I think it's still not late enough to enter the scheme.
All right, well, we have to take another break on that note, but we're not done yet. We are analyzing some of the biggest funds of India. We have one more fund for you, and this one is from the State Bank of India universe, the SBI MF universe. We'll be back with the analysis in just a moment. Welcome back. You're watching Money, 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 and this week we are analyzing some of the biggest mutual fund schemes of this country. And we have one more scheme for you. This is from the SBI universe. We thought we'll offer some diversification because the top three schemes happen to be from HDFC. Which one from the SBI universe do you have your eye on?
So the sixth largest fund in the chronological order of size is SBI, State Bank of India's BLUECHIP scheme, managed by Sohini. Sohini has been managing it from 2010 September. Of course, she has a very good track record of managing schemes. She's also the head of research for SBI. So if you have a larger role, and then if you're heading research, then you have more inputs from the analyst, and you're right in the ground to go meet the corporates. unfortunately, last 6-8 months has been not so good because she went a little defensive. She didn't have cyclical stocks in her portfolio and they ran up. I think over a 3-year basis, she's done very well to beat Nifty by 3%. So stay on is the recommendation, to be a little quick.
Despite the size, 19,000 crores.
Correct, but despite the size, because it has recently grown in size, last 3-4 years it has grown in size. HDFC Prudence and HDFC Equity, on the contrary, unlike this one, have been largest for the last 5, 7, 8 years. So the problems are more ingrained, more deep-rooted than in the cases which have recently become the larger ones.
Okay, so now final thoughts and perhaps some recommendations or tips to our investors. Always very difficult to pick the right fund. We know you can't go by size anymore. We know you can't go by past performance. So what are the 2 or 3 key things perhaps that a retail investor can keep in mind before picking the mutual fund he or she desires?
So 3 tips. One is make sure that you don't have too many funds of one asset management company. Ideally, if you have 5 funds in your portfolio, none of them should be, you should not have 2 from one fund house. That's tip 1, and I think it's very important. Tip 2 is to make sure that you don't have funds greater than 10,000 crores, ideally, unless you have a very strong reason to be in and you have done more research. Third tip is that whenever you are looking at a fund and its review, make sure that you not just look at the return, because return has a negative correlation to future. So it would have done very well in 2017. That's not reason enough to buy it in 2018. So you can use electronic medium like Money Show is a very good platform where the funds are being discussed. On an annual review, if you discussed, you saw that if you can't afford a financial planner, this medium becomes a very, very important medium to take decisions.
Okay, well, be informed and make sure that you think about all the options, a lot of the different variables that are out there before you make your choice. Thanks, Feroze, very much for being with us on the show this week and analyzing a lot of these very interesting funds for us. That's it on this week's edition of Money. Your feedback, comments, queries, welcome as always. We'll see you again next week.